The following is presented for educational commentary and should not be taken as a personal statement from any named individual. Always do your own research. While the entire world was watching the biggest AI stock rally in the history of the American market last month, while every TV channel and every financial website was filled with headlines about trillion-dollar valuations and robots taking every job on Earth, something far more important happened that almost nobody noticed. While Wall Street was popping champagne over Nvidia crossing $3 trillion in market value, a small group of quiet, boring, almost invisible stocks did something remarkable. They went up. Not because of AI, not because of hype, not because of any headline at all. They went up because they have always gone up when the world gets confused and scared. And in my view, that tells you infinitely more about where your money is actually safe than any AI press release ever could. The line that just crossed on the chart of these four companies is the loudest silence in the history of investing. And I want to walk you through exactly what it says and why it matters to you, especially if you are a retiree, a pre-retiree, or someone who is watching your savings and wondering what happens if this AI bubble pops the same way the dot-com bubble popped back in the year 2000. Stay with me to the end because the last part is the part no one ever tells you. I promise you that. My name is Mark. I have been watching markets for a long time. I have been wrong before. I will be wrong again. But what I am about to show you is not a guess. It is a pattern. And patterns, when you understand them, are the closest thing to a superpower that an ordinary investor ever gets. Let me give you the big number first. Then I will explain everything around it. The number is 1600. That is the number of days, roughly 4.5 years, that it took the NASDAQ to lose 78% of its value after the dot-com crash began in March of the year 2000. 1,600 days of pain. If you had put 500,000 into a NASDAQ index fund in January of 2000, by the time the bottom came in October of 2002, you had about 110,000 left. That is not a typo. You lost 390,000. And it took until April of 2015, 15 years, to get all of it back in real terms after you adjust for inflation. Now, I'm not saying AI is going to crash tomorrow. I am not saying AI is a fraud. What I'm saying is this: there is always a moment, always, when the smartest money in the room quietly moves out of the shiny thing and into the boring thing. And right now, in 2026, I believe that moment is either here or it is very close. And the four stocks I am about to name are exactly where that quiet money tends to go. Let me take you back to where this story really starts. The year is 1996. Alan Greenspan, who was the chairman of the Federal Reserve at the time, stood up in front of a room full of bankers and said two words that changed history. He called the stock market irrationally exuberant. The Dow Jones was at 6,400 at the time. People laughed at him. They said he was old. They said he did not understand the new economy. The internet was going to change everything, they said. And you know what? They were right. The internet did change everything. But the stocks went up another 100% over the next 3 years before they crashed. And then they fell 78%. The technology was real. The valuations were not. Fast forward to today. Artificial intelligence is real. It is genuinely going to change things. But the stock prices of the companies riding the AI wave have gone up 400%, 600%, even 1,000% in some cases since early 2023. And the earnings, the actual profits, have not kept pace. Not even close. Warren Buffett has not bought a single major AI stock, not one. Instead, in 2025, his company Berkshire Hathaway sat on $325 billion in cash. That is $325 billion, just sitting there, earning about 5% in treasury bills. When the most successful investor in the history of the world decides to hold $325 billion in cash instead of buying any of the most exciting stocks on earth, I think that deserves our attention. Show on screen chart of Berkshire cash pile versus NASDAQ performance 2023 to 2025. Now let me walk you through the 4 stocks. These are not glamorous. They are not going to make you feel cool at a dinner party. But if AI crashes, and even if it does not crash but just slows down, these 4 companies are built to keep your money working. The first one is Berkshire Hathaway itself, ticker symbol BRK. I know, you might be thinking, Mark, that is not exciting. You are right, it is not exciting. That is the point. Berkshire owns 60 to 80 different businesses outright. It owns GEICO, the car insurance company. It owns BNSF Railway, one of the biggest railroads in North America. It owns See's Candies, Dairy Queen, Fruit of the Loom. It owns big chunks of Coca-Cola, American Express, and Bank of America. None of these companies need AI to survive. People still need car insurance whether a robot writes their emails or not. Trains still carry coal and soybeans whether the tech sector is booming or crashing. When the dot-com crash happened between 2000 and 2002, Berkshire Hathaway stock went up about 30%, while the Nasdaq fell 78%. That is not a coincidence. That is the point of the business. Now, some of you will say, Mark, Berkshire is too big. It cannot grow fast enough to matter. Let me show you why that argument misses the point. You are not buying Berkshire to get rich quick. You are buying it so that when the storm comes, your money is inside the strongest barn in the county while everyone else's money is outside in the rain. Buffett has said many times that his job is not to beat the market every year. His job is to not lose. Rule number 1, he says, do not lose money. Rule number 2, do not forget rule number 1. That is still the best investment philosophy I have ever heard in 50 years of paying attention. Voice drop. The second stock is Procter and Gamble, ticker symbol PG. This is the company that makes Tide laundry detergent, Pampers diapers, Gillette razors, Crest toothpaste, Bounty paper towels, Dawn dish soap, and about 65 other products you probably bought this week. Here is the thing about Procter and Gamble. People do not stop brushing their teeth when AI stocks crash. They do not stop washing their clothes. They do not stop buying diapers for their grandchildren. The demand for these products is what economists call inelastic. That is a fancy word that just means people buy them no matter what. When the economy gets bad, people might skip the fancy restaurant. They do not skip the toothpaste. Procter and Gamble has paid a dividend. That is a cash payment to shareholders every single quarter since 1890. 1890. That is before cars existed. That is before airplanes existed. The company has raised that dividend every single year for 68 consecutive years. They call companies like this dividend kings. There are only a handful of them. And in 2026, Procter & Gamble's dividend yield is sitting at about 5%. That means if you put $100,000 into PG stock today, you get $2,500 per year in cash just for owning it. And that cash payment goes up almost every year automatically. Show on screen Procter & Gamble dividend growth chart 1970 to 2026. During the 2008 financial crisis, remember that? Banks were failing. Lehman Brothers went bankrupt. The S&P 500 fell 57% from peak to bottom. Procter & Gamble stock fell about 33% at its worst. Then it came back fully within 2 years, and the dividend kept coming the whole time, every quarter, without fail. That is the kind of stock that lets a retiree sleep at night. Last week, a viewer named Sandra from Tucson wrote me this. She said, Mark, I am 67 years old. My financial advisor has me in tech funds and I am scared. What do I do? Sandra, this video is partly for you. What you do is you ask your advisor to show you exactly what percentage of your money is in companies that need the AI story to stay good. If that number is more than 20%, you have a conversation. You do not panic and sell everything. You just get honest about the risk you are carrying. The third stock is Johnson & Johnson, ticker symbol J&J. Now, I want to be careful here because Johnson & Johnson has been through some legal trouble in recent years related to its baby powder products. The company has paid out billions in settlements. That is a real thing. I am not going to pretend it is not. But here is what else is real. Johnson & Johnson is one of only 2 companies in the entire S&P 500 with an AAA credit rating from Standard & Poor's. The other one is Microsoft. And AAA rating means the bond rating agencies believe Johnson & Johnson is more likely to pay back its debts than almost any other company or government on earth. That includes the United States government, which carries a lower rating. Johnson & Johnson makes medical devices, pharmaceutical drugs, and consumer health products. The medical device business alone serves hospitals and surgical centers all over the world. Hip replacements, knee replacements, surgical robots, eye surgery equipment. These are things people need whether the stock market is up or down. An 80-year-old man who needs a new knee does not postpone his surgery because Nvidia had a bad quarter. And here is the number that matters to you as a retiree or near retiree. Johnson & Johnson has raised its dividend for 62 consecutive years. 62 years. The dividend yield right now is about 3.1%. That means 100,000 in J&J gives you roughly 3,100 per year in dividend income, and that income has gone up every single year for more than 6 decades. I want to pause here and tell you a story. Bear with me for 1 minute. This story is from 1973. The year is 1973. The American stock market fell about 48% over 21 months. It was caused by an oil embargo, rising inflation, and a political scandal that you may remember called Watergate. People were terrified. Mutual funds were being liquidated. Investors were pulling money out of the market at a record pace. A young Warren Buffett, he was 43 years old at the time, went on a buying spree. He bought shares of the Washington Post Company. He bought shares of Geico. He bought shares of companies that made things people needed every day, and he held them. He did not sell when the market kept falling. He did not sell when the news got worse. He held, and by 1976, when the market recovered, his portfolio had tripled. Now I am not Warren Buffett. You are probably not Warren Buffett either. But the lesson from 1973 is the same as the lesson from 2000, from 2008, and from 2020. The people who win in the long run are the people who own real businesses that sell real things to real people. Not hype, not hope, real things. Voice drop. The fourth stock is Coca-Cola, ticker symbol KO. I know what some of you are thinking. Coca-Cola? Really? Is not that the company my grandfather owned? Yes, and your grandfather was right. Coca-Cola sells 2 billion servings of its products every single day, not per year, per day. 2 billion in more than 200 countries. Coke, Sprite, Fanta, Powerade, Minute Maid, Dasani Water, Costa Coffee. The company has been paying dividends since 1893. 1893, it has raised that dividend every single year for 64 consecutive years. The current yield is about 3%. Warren Buffett's company owns 3% of all Coca-Cola shares. That stake is worth about $25 billion in 2026. And here is the beautiful part. Buffett bought most of those shares back in 1988 and 1989. He paid about $1.3 billion for them. The annual dividend income that Berkshire now receives on those same shares is about $776 million per year. Every year. Without selling a single share, his annual dividend income is now 60% of what he originally paid for the whole investment. That is the power of owning a real business for a long time. Now let me connect this back to the AI story, because this is the part no one is telling you. And I promised I would get here. Here is what is actually happening in 2026. The companies building AI, the Nvidias, the Metas, the Alphabets, the Microsofts, are spending enormous amounts of money to build out AI infrastructure. Nvidia alone is expected to sell over 150 billion worth of chips this year. That is incredible. But here is the question the market is not asking loudly enough yet. Who is buying those chips? And are they making enough money from AI to justify what they are spending? Microsoft has invested over $13 billion in OpenAI, Amazon has committed $4 billion to Anthropic. Google has poured billions into its own AI projects. These are real bets, big bets, but the return on those bets is not yet clear. Not in concrete profit terms, not yet. And history tells us very clearly that when big companies spend enormous amounts of money on new technology before the revenue model is proven, some of them win big and some of them lose big. And a lot of the smaller companies that got caught up in the excitement lose almost everything. Show on screen. Capital expenditure chart for AI infrastructure spending 2024 to 2026. This does not mean AI fails. The internet did not fail, email did not fail, smartphones did not fail, but pets, Com failed, Webvan failed, eToys failed, Excite failed, WorldCom failed, Global Crossing failed, and the investors who own those companies lost real money, real retirement money. Some of you will say, Mark, but the 4 stocks you named are boring. I cannot make real money with boring stocks. Let me push back on that. Let me show you the math, because the math is interesting. If you had put $10,000 into Coca-Cola stock in January of 1990 and reinvested every dividend, you would have about $280,000 today. If you had put $10,000 into Johnson & Johnson in January of 1990 with dividends reinvested, you would have about $320,000. Procter and Gamble, same situation, same $10,000, you would have about $270,000. Berkshire Hathaway, the same $10,000 in 1990, you would have about $410,000. None of these numbers are estimates. These are real historical returns. You can look them up on any financial data site tonight. Now compare that to the dot-com investors who put $10,000 into a NASDAQ index fund in January of 2000. By October of 2002, they had $2,200. It took them until 2015 to get back to $10,000 in real purchasing power terms. 15 years to break even. Voice drop. I want to say something now that is going to sound harsh. I do not mean it harshly. I mean it as a friend who has watched a lot of people make this exact mistake. If you are 60 years old or older and you have more than 30% of your savings in high-flying tech stocks or AI funds, you do not have time for a 15-year recovery. You just do not. If the AI crash comes, and I'm not saying it will, but if it does and it looks anything like the dot-com crash, a 60% decline in your tech holdings could take you from comfortable to struggling in less than 2 years. And no government program, no Social Security check, no part-time job is going to make up that gap in time for it to matter. I've been wrong before. I could be wrong about the timing here. Maybe AI stocks go up another 50% before they come down. But the question I want you to ask yourself tonight is not, can I make more money? The question is, can I afford to lose what I have? Now let me give you the 3 things. These are the 3 concrete steps I would take if I were sitting in your situation right now. First, look at your portfolio today. Not next week, today, and find out exactly what percentage is in technology stocks, AI-related funds, or any fund with the words growth, innovation, or technology in its name. Write that number down on a piece of paper, just the number. You do not have to do anything with it yet. Just know it. Knowledge is the beginning of control. Second, look at whether you own any of the 4 stocks I mentioned today: Berkshire Hathaway, Procter and Gamble, Johnson & Johnson, and Coca-Cola. If you own none of them, ask yourself why. I am not saying you must buy them. I am not your financial advisor. But if your answer is, I never thought about them because they are boring, that is worth examining. Boring has a very good long-term track record. Third, have one honest conversation with your financial advisor about what happens to your income, your actual monthly income from your portfolio, if your tech holdings drop 50%. If your advisor cannot give you a clear, confident answer to that question, that is, information 2, a good advisor should be able to run that scenario for you in about 5 minutes. If they brush you off, find a different advisor. Those 3 steps cost you nothing. They take maybe 2 hours of your time total. and they could save you years of stress. Before I close today, I want to address one more thing. People sometimes ask me, Mark, what if you were wrong? What if AI keeps going up and the boring stocks lag behind? That is a completely fair question. And here is my answer. If AI keeps going up and Coca-Cola only goes up 8% this year instead of 40%, you know what you will have? You will still have Coca-Cola, still paying its dividend, still raising it every year, still serving 2 billion drinks a day, still here in 10 years. You miss some upside. That is the cost of sleeping well at night. I think that is a trade worth making for most people at or near retirement age. What happens if AI crashes and you do not own any of the 4 stocks I mentioned? You get the downside without the floor. That asymmetry, the idea that the cost of caution is limited, but the cost of recklessness can be catastrophic, is the most important thing I know about investing for retirement. Voice drop. Warren Buffett once said something that I have carried with me for a long time. He said, "Be fearful when others are greedy, and greedy when others are fearful." In 2026, with AI stocks at record valuations, with the entire financial media world focused on trillion-dollar chip companies, with more retail investors buying technology funds than at any point since 1999, I think it is worth asking yourself honestly which side of that equation you are currently on. I am not telling you to be fearful. I am telling you to be thoughtful. There is a difference. Thoughtful investors look at boring companies with real earnings, real dividends, and real histories. Fearful investors panic sell. Thoughtful investors just quietly rebalance. Let me say one more thing before the close. This is for the viewers who wrote in after my video on the gold market and the one on Berkshire Hathaway's cash pile. You asked me, Mark, is there a safer way to hold these 4 stocks? The answer depends on your tax situation, your age, and your account structure. But in general, holding dividend stocks like these inside a Roth IRA or a traditional IRA can help you avoid taxes on the dividend income until you take it out. That is a topic I am going to go deep on in the next video in this series. I promise you that episode is going to connect a lot of the dots from everything we have talked about these past few weeks. If you have a spouse, a sibling, or a parent who is in or near retirement and has more tech exposure than they realize, please think about sharing this video with them tonight. Not because I need the views, because they might need the information. That is the only reason I make these videos, to make sure the people who should know this stuff actually know it. If this video gave you something useful, something that helps you think more clearly about the most important investment decisions you will make in the next 3 years, please subscribe and hit that bell so you get the next one when it comes out. Because the story I have been following, the Berkshire cash pile, the gold market signal, and now these 4 stocks, is not finished. In fact, it is just heading into the chapter where most people lose the most money. I would rather you hear what comes next from someone who is trying to give you the truth than from someone who is trying to sell you excitement. I will see you in the next one. And one last thing. A decade from now, in 2036, you are either going to look back at this moment and say, I understood the risk, I made a thoughtful choice, and I protected what I built. Or you are going to look back and wish someone had told you the truth in plain English while there was still time to act. I am trying to be that person for you today. Please do your own research. Talk to a real financial advisor who knows your specific situation. Every person's situation is different. What is right for one person is wrong for another. But the 4 principles we talked about today: own real businesses, look for consistent dividends, understand your risk level, and ask what happens if everything drops 50%. Those principles are right for almost everyone. Take care of yourself, take care of the people you love, and I will see you in the next video.